Hello everyone. I hope you're doing good, mentally and physically fit and fine. So, guys, let's start with the lecture. Okay, so let's target a new chapter today, chapter number 6, and let's try to do maximum questions from here and maybe go to chapter number 7 also. Okay, guys, so this is chapter number 6, completion and review, and the first standard is SA 560. And the first question is a very popular one, has been asked again many and many times. And the question is, what is auditor's responsibility with respect to subsequent events? What is responsibility of the auditor with respect to subsequent event? And then it has been asked in the study material also. In study material, they framed a case that a very simple. It's a airline. They're into airline company supplying foods. They're into supplying food and supplying food to airline company. And then they are supposed to maintain stock for 1 month. For coming 1 month, they have to maintain the stock. And average holding is 75 crores. 75 crores settled by the company within 45 days of the supply of the goods. Okay, everything was going well till March 2020. Everything was going well till March 2020 when pandemic hit the world. Everything was standstill, aviation sector was hit hard, and there is no flights from April 2020. Consequently, the business of PQ also got severely affected, and the scheduled supplies goods to airlines were not made. Also, the liquidity position of airline companies got hit, and the scheduled payments were not received on due date. So basically, we are a supply company. We are a supply company because of COVID. Airlines got hit because of airlines. The supplying company, the food company is also hit. As an auditor, what audit procedure would you perform to ensure that all subsequent events, simple, all subsequent events are considered so that financial statement of the year represent the true and fair view. So basically, they made a story, they made a complete story. Now this is what they do, but then ultimately what they're asking is the same thing. So a one-line question and a complete case study question in this particular situation is exactly same. Okay, guys. So let's see. Now, in this particular answer, we have see, institute keeps changing their answers as we go ahead. Earlier, they used to put definition of subsequent event as per AS, Ind AS, and then definition of subsequent event as per SF 560. And then they used to go to the main content. What is the responsibility of the auditor with respect to subsequent events? What is the responsibility of the auditor with respect to subsequent events? We can ignore this part. Now, giving definitions, they did this in the past, but then it is not required. It is really not required. Giving, and especially giving definition as per AS4 is not required. So you can ignore this part. No need to give definition of subsequent event as per AS4. No need to give definition of subsequent event as per SF 560. You can directly go to the responsibility. You can directly focus on this particular part. Okay, now it is interesting to understand. When we see SF 560, it gives us responsibility of the auditor after balance sheet date till the date of signing audit report. Then it also gives responsibility of the auditor after signing audit report till the date of publishing of financial statements, and also gives responsibility after date of publishing financial statement. So SF 560 gives us 3 types of responsibilities: after date of signing till after balance sheet till the date of signing audit report, after signing audit report till the time they are issued to public, and after they are issued to public. So whenever question is silent, whenever question is silent, they are simply asking audit responsibility. But which audit responsibility? Which particular audit responsibility are you asking us? They don't specify. Then you need to explain them responsibility after balance sheet till the date of signing audit report. So keep that in mind. If they're silent, which responsibility they exactly want. So this is the response you're supposed to explain. Okay, guys, let's see. We will go to 560.060 and there so you can, if you have audit titanium book, that's fine, or else you can simply follow your concept book, and this is what you're supposed to write. So the first thing you're supposed to write, yes, year has come to end. Then also year end has happened, but then also, just a minute guys, but then also it is auditor's duty to perform audit procedures, obtain sufficient appropriate audit evidence that management has analyzed subsequent events properly, identified the adjusting events, identified the adjusting events, and they have done its proper accounting. So you need to explain, yes, even though year end has happened, still auditor is responsible for performing audit procedure, getting sufficient appropriate audit evidence, that management has analyzed the subsequent events properly, identified the adjusting events, and made proper accounting entry. So it is within the duty of the auditor. And if auditor has already checked subsequent event in some areas, like debtors, they have already checked subsequent recovery, creditor, subsequent payment, no need to check again. What audit procedure they need to perform? Sorry. What audit procedure they need to perform? Number one, see, there are 4 audit procedures they need to perform. So first you can remember, they need to interact. They need to communicate. First, they need to understand management's procedure for analyzing subsequent events and identifying adjusting events. So we need to understand what is management's procedure. So they must have kept 2 chartered accountants, one chartered accountant to independently analyze every week what are the adjusting event, and another chartered accountant. So 2 chartered accountants are working independently and identifying adjusting events, going to CFO, and then CFO decide which entry should be passed. So understand management's procedure for identifying adjusting event and passing accounting entries. Then do inquiry from them. Then you go for inquiry. You already have a list. See, you must be having the list. What kind of adjusting events happened in the previous years? What kind of adjusting events happen in the industry? Okay. And what were expected. So go with the list, ask them whether such things have happened, and see whether those adjusting events are accounted for. So first understand management's procedure, then you do inquiry, then look for documents. Get minutes of shareholders meeting, board of directors meeting, audit committee meeting. These are very important meetings after year end. Going through those minutes, you may come across the adjusting event. For example, you may come across proposed dividend. Proposed dividend, you don't need to pass accounting entry, but you need to show it in notes to accounts. A lot of important things and adjusting events may be identified by reading the minutes. Apart from that, now, after financial statements which are prepared after year end, they are called subsequent financial statements. And when they are prepared for a month or a quarter, they are called interim financial statements. So that is called subsequent interim financial statement. Ask for the subsequent interim financial statement prepared after year end, monthly, quarterly financial statement prepared after year end. Ask them, why sir? Because go and see all the major transactions in those financial statements. Again, those major transactions may be in the nature of adjusting events. So it's very simple. Yes, you explain it is auditors, even though year end has happened, it is auditor's duty to perform audit procedure for subsequent events. Then what kind of audit procedure? 2 types of interaction. Understand their procedure and do inquiry from them. 2 types of documents. Get the minutes and get the latest subsequent interim financial statement. Then next, if you come across adjusting event, ensure that they are properly accounted for. Ensure that they are properly accounted for. If they are not properly accounted for, then management will have, auditor will have to modify the opinion. And lastly, take the written representation. Take written representation that they have disclosed they have analyzed all the events properly, and they have disclosed, they have analyzed all the events properly, they have identified adjusting event and past accounting entries, and they have given all the information to the auditor. They have not kept hidden anything. So do these four things. Doing these four things is auditor's responsibility. These 4 points: explaining that it is duties, then give the details of audit procedure, what to do when you get adjusting treatment of adjusting events, and written representation. So you need to explain these 4 things, guys. I hope this, again, if you remember these 4 points, if you remember these 4 points, okay, this will be great, guys. Now let's come to, now there is a question from study material. There's a question from study material. Let's understand it from the new study material. So it should be little bit interesting. A very simple. So there's a company, and they're into manufacturing of shoes and sleepers. And due to unprecedented rains in the area in the month of September, many areas of the town are having problems. There is flooding of waters. The company lost a claim of 1 crore, and same is showing 31st of March was not settled. So basically, it's very simple. As on 31st of March, there is a 1 crore. There is a claim outstanding of 1 crore. The insurance surveyor appointed in the case submitted report to insurance company, and surveyor says that only 45 lakhs in the month of April, only 45 lakhs should be given. The company has given consent for the same and was settled 45 lakhs. You have just finished performing substantive procedures of the company by the end of the May 23. Is any responsibility cast upon you as the auditor of the company in the above situation? Okay, so it is pretty simple, guys, that as on 31st of March, accounting entry was passed of claim receivable 1 crore. And now there's an uncertainty involved. There was an uncertainty involved whether they will get 1 crore or not. And then subsequently, surveyor says that 45 lakhs will be given to you. Company agreed to it, and they got the money. Okay. So as per India's 10, and as per Accounting Standard 4, it is an adjusting event. You are getting more. It is an adjusting event. You are getting more clarity. It should be accounted for, and the claim of 1 crore should be reduced to 45 lakhs. It should be reduced to 45 lakhs, and the accounting entry should be passed for it. Adjusting entry should be passed for it for the year ended 31st March 2023. It is a very simple thing. It is an adjusting event. It is an inter-level problem, guys. It's an inter-level case study. So it is pretty simple. And and they have not, this answer should be elaborated. I think this answer should be, see, institute has given very short answers. I don't think we should go with those short answers. We should be careful. We should give a proper elaboration. So I think in this, first you need to explain what Ind AS 10 and AS4, what they talk about. Simply explain what is subsequent event as per them, and in that explain adjusting and non-adjusting events. Okay, then you should explain auditor's responsibility. Then case discussion should happen, and then conclusion should happen. And so what India's 10 AS for simply says, all the events which are happening after balance sheet date till the date of approval of financial statement, they are subsequent events. And if they are clarifying the contingency, uncertainty existing as on balance sheet date, it is an adjusting event. Otherwise, it is a non-adjusting event. Very simple. And then auditor responsibility we have just discussed the case, and the conclusion is that it should be accounted for. The claim of 1 crore should be reduced to 45 lakhs. That's it. Okay. So pretty simple, guys. Come on, let's go. Pretty simple, pretty straightforward. Now, specific inquiry. So this has been asked in May 22 mock paper. May 22 mock paper, guys. Matters with specific inquiry may be conducted. So it's a very simple thing that they are asking when you go for checking of subsequent events, what specific inquiry can be done? What specific inquiry can be done for subsequent events? It is pretty simple, guys. So essay 560 essay 560 basically gives the list that when you want to go and do inquiry, you can ask these questions. You can ask these questions to the management. Okay. Before we go into it, India's 10 says that okay, no need to make up any accounting. No need to do accounting for non-adjusting events. Absolutely fine. But if they are material nature, material nature, then major non-adjusting things should be disclosed in notes to accounts. So India's 10 says that absolutely fine. If you are not doing accounting for non-adjusting event, that's perfect. But then if they are material, you should disclose it into the notes to accounts. So it's very simple. Adjusting event, do the accounting, take the effect, and non-adjusting event, if material, show it in notes to account. So keeping that in mind, they have drafted this list that for some things accounting entry will be passed, and for some things a disclosure will go in notes to accounts. Okay. So what I have done is first of all, let's see. Okay. So on the same lines, what I have done here, if you see to our titanium book, specific inquiry, what I have done is I have grouped it that some inquiry is related to assets, some is related to capital and liability, and some is related to the all items, whether it is assets or liability. So when you go for such grouping, it is easy to understand and easy to retain. So we have grouped it. Some connected to assets, some connected to capital and liabilities, some connected to all items, guys. Come on. So first, remember this grouping. Now, assets. So for assets, we are going to inquiry whether management has done any sale or acquisition. Whether management has planned or done any sale or acquisition of the assets, major assets. We are going to do inquiry. If yes, if they have done or planned any major sale or acquisition of assets, okay, then if they have done that, then it should be shown in notes to accounts. Then after sale and acquisition, next is appropriation or destruction. What is that? It's very simple. Whether after year end government has done any appropriation of assets and taken away whether they have done any compulsory acquisition, whether they have done under compulsory acquisition, appropriation, or there is destruction of asset. If yes, it's a big thing. It should be disclosed again in the notes to accounts. Then again, with respect to assets, whether after year end, whether any major thing has happened which affects the recoverability of the asset. For example, if a particular product is banned, gets banned, then it is difficult to recover the amount of difficult to recover amount of that particular plant. Okay. So we'll have to explain this in notes to accounts. See, guys, this list is prepared keeping in mind the concepts of India's 10, that for adjusting event, accounting entry should be passed. For non-adjusting events, disclosure should be given notes to accounts. Many of the items are with respect to disclosure in notes to accounts. So for asset, ask very simple thing, whether after year end, whether there is any major sale or acquisition of asset, whether there is major appropriation or destruction of asset, whether there is anything which affects the recoverability of the asset. Okay. Then, guys, capital related, whether after year end there is major change in the capital, debt instruments, or mergers and liquid. Whether after year end there is a major change in the capital, that is equity share capital or debentures, whether there is an increase, whether the issue of shares, the issue of debentures, or major change in the capital because of acquisitions, mergers. If yes, again it should be shown in notes to accounts. Okay. So some capital liability related points. Then commitments. Whether after year end, company has entered into new commitments, borrowings, or guarantees. Capital commitment. Whether company has done major borrowings, whether borrowings or capital commitments. If yes, again disclose in notes to accounts. If then contingencies. If contingencies were present as on 31st of March, whether there is any new development about it, litigation was pending, whether there is new development about it, proceedings were pending with SEBI or RBI, whether there are new developments about it. What are the new development? Go and ask it. It may lead to adjusting event. Inquiry about events affecting the measurement of estimates. Whether anything has happened which affects the measurement of estimates or provision. For example, government, we came to know that government is changing their rates, their tax rates or royalty rates or something like that. Because of that, our provisions will change. Whether anything has happened which affects the measurement of provisions and liabilities. Okay. So when it comes to capital side, whether there is any major change in the capital, whether there is major change in the commitments and borrowings, whether major change into contingencies, whether there is anything which affects the measurement. Then all items. Inquire about unusual accounting adjustments. Whether unusual accounting adjustments have taken place. Okay, after year end, whether unusual adjustments have taken place, they may be adjusting in nature. For example, heavy sales return. When you did a little bit of digging, when you did a little bit of research, you found that these sales never happened. You may come across that. So go and check heavy accounting adjustment after year end. It may show that they need to be accounted for in the current year only. They may be adjusted in the current year only and not the next year. Whether there is anything looking at which we think that our accounting policy should be changed. For example, long-term investments are sold after year end. So how come you can sell long-term investment within a month? That means our policy with respect to certain investment need to change. Let's freeze, guys. A very simple thing. So SA 560 explains what specific inquiry you should do for the subsequent events. We have divided into three parts. Inquiry with respect to assets, whether there is sale and acquisition of the assets, whether there is appropriation or destruction of the assets, whether there is anything which affects recoverability of the assets. Then inquiry for capital and liability related items, whether there is a change in the capital related points, whether there is increase in capital, debentures, etc., whether any change in commitments and borrowings, okay, whether there is any change in the contingencies, whether there is anything which affects the measurement. And go and look for all items for major accounting adjustments in this period. They may be adjusting in nature, and whether there is anything which is asking us to rethink about the accounting policy, accounting adjustments, and appropriateness of accounting policy. So guys, this question may come. It has been there in May 22 mock. What specific inquiries should be done? Okay. Guys, this particular session is exclusive for South India students, for the English students. For those who are looking for the Hindi lectures, English lectures, then those lectures will be at 11 o'clock. 11 o'clock, we are going to have an English lecture, guys. Now, let's see, guys, beautiful cases we have seen till now. We have seen auditor's responsibility for the subsequent events. Then we have seen a case about the adjusting events. Then we have seen subsequent inquiry also, guys. Now, this question was asked in study material 23, and before this it was there in November 18 exams. It was there in November 18 exams. Okay. So our views are asked what should be done. Okay. So it is a very interesting case. A very, very interesting case. So now, so company prepared their financial statements, and after the financial statements were prepared, government government of India approved a uh, compensation for the company of 5,800 crore incentive. Government approved. So year end happened. After year end happened, financial statements were approved. Financial statements were approved. Okay. And then government approved the incentives which was pending, approved, and it is paid. Looking at this, company was very happy. So after the year end, after financial statement were approved and prepared, they got the news about the incentive. They immediately revised their financial statements, and included they immediately revised their financial statements, and they included 5,800 crore, 5,800 crores as their income. They adjusted it and they prepared a revised financial statements. So what, as the auditor, analyze this particular issue and give your views? Auditor should auditor go for the revised audit report. I hope you got the point. Once again, guys, it's pretty simple. So year end has happened. 31st March, year end has happened. Then auditor signed the audit report. Fine. So year end has happened. Financial statements are finalized. Auditor signed the audit report. And so these things were done. Within 2 days, they got the news that things are approved and they are going to get 5,800 crore would be paid before the May end. And and that's a very good news. So immediately, see, audit report is signed. Within 2 days, they got the news, and after 2 days, board of directors says that we would like to amend accounts, include that revenue, include that revenue, and make a revised financial statement. And we need a revised audit report from you guys. Okay. Now, what should be done in this case scenario? So this has been asked in November 18 exams, and it is there in the study material 23 also. It's in the study material 23. So basically understand this. Here things are happening after signing audit report. Here things are happening after signing audit report. Okay. So in SF 560, in SF 560 we have a concept. If you come to know facts, okay, if you come to know facts about the earlier period after signing audit report, if you come to know facts of the earlier period, which if known earlier would have changed your opinion, such big facts if you come to know, okay, then in that case you need to perform certain audit procedures. Now guys, I'm not fully happy with the way they have treated the case, but then I am telling you what point of view they took. There is a small problem with that, but let's go with their point of view, and then I will let you know what's the problem with their point of view. So let's freeze once again. So SF 560 says that auditor's responsibility till the date of signing audit report is different, and auditor's responsibility after signing audit report is different. This particular case is after signing audit report. Everything is happening after signing audit report. So first you need to understand, we need to apply auditor's responsibility after signing audit report. So what it says? Well, it says a very simple thing. First thing, it says that no obligation at all. This is after date of signing audit report. It says that after signing audit report, auditor is not under any obligation to perform any audit procedure. Any audit procedure. Okay. But but if he comes to know any information, any fact of the earlier period, okay, which existed, which earlier period, if he comes to know any information, any fact of the earlier period, which if he would have come to know earlier, he would have changed his opinion. If before signing, he would have come to know that, oh my God, 5,800 crore is approved. That's a very big amount, and it is confirmed they are going to get this amount. Now there is no contingency involved. It is fixed they are going to get this amount. If he would have got this information before signing, he would have asked management to do the accounting. Okay, it would have asked management to do the accounting. It would have changed his approach. It would have changed his opinion. That's such a big thing. So they said, oh yeah, after signing audit report, this is there. If this fact would have known before, he would have changed his opinion. He is supposed to simply go and discuss whether this is the truth. We came to know about it. Whether this, whatever information came to know, go and discuss. Go to the cabin of the management and go and discuss with them. Is this the truth? What are all the details? Let me know about it. What are all the details? If it's the truth, come to your own cabin and think carefully whether financial statement need to be revised. Whether we should show this income, this receivable. Okay. If answer is yes, give a call to them. Inquire, are they ready to change it? Are they ready to amend financial statements? If management is ready to amend financial statements, if they are ready to revise financial statement, give a revised audit report. If they are ready to revise financial statement, okay, give a revised audit report. It's very simple. Go and check that particular adjusting event. Extend your audit procedures to the new revised audit reports date. Extend your subsequent audit procedures to new date. Okay, so check that event, extend your audit procedures, check everything, get the revised financial statement, and then give revised audit report. Absolutely fine. So yes, we are going with the management. They want to make revised financial statement. We will give you revised audit report. Discuss the case and give conclusion. We can issue. Okay. There's only one small issue with this, which is technically, when we discuss fact, okay, see, Board of Studies, CA Institute said that it is after audit report we came to know about the facts and they have done it accordingly. There's a small problem with that. When we say the fact, we say that the fact of the earlier period, which was there, but we came to know this right now. That is called as facts. Facts, information which existed at the time of signing, but we came to know it right now. Okay, so we came to know it right now. That is called as fact. In this case, things are happening after audit report. So this is some technical problem. But then, as I said, if you get a similar question, go with what institute says. You can give a note after that. There's a technical problem. There's a technical problem. Okay, this is not the fact which was existing at the date of signing audit report. Okay, that's the only technical problem for giving about treatment. But then this treatment is popular and has been discussed in the past cases and problems. You can write that note clearly so that the reader understands. Okay, he knows the other point of view also. Okay guys, let's freeze. Let's go ahead. So we have discussed guys, auditor's responsibility till the date of signing audit report. We have discussed in this auditor's responsibility after signing date of audit report. We have discussed adjusting events. We have discussed specific inquiries. We are through with 560. Lovely, beautiful cases. Lovely, beautiful cases. We are there with respect to 560. Now let's talk about 570, guys. 570, 570, 570, 570. Okay. So first question comes from study material 23. Study material 23. And let's understand this, guys. Okay. Now, so what's the case? So case is, there's a power generating company. There's a power generating company, and they got, for power generation you need a lot of coal. So they got the allotment of coal blocks. They got the allotment of coal blocks, but then there was a scam. There was a scam there was a scam involved in the allocation, and scam involved in the allocation of the coal blocks, and this allotment was blocked. It was banned. So this thing happened in the month of December 23, and everything came to halt. Because of that, the complete power generation has stopped. So basically, there's a power generating unit. They need coal. They were allotted the coal block, but suddenly that that was banned. That was banned, and now because of that ban, the production process has stopped. Many key management personnel have left. There are delays with the payment of wages and salaries, and banks from whom uh, they are not ready to extend the loan period. They want their money back. Their finance problem also, and they are not having money for. So there are problem. There are a lot of problems. There are problem with the working capital also. There's a problem with working capital, and companies not having any action plan to mitigate such circumstances, not reflected in the financial statements. What course of action should the statutory auditor of the company consider in such case? What course of action should be there? Okay. Now listen, guys. So problem is that company is facing a lot of issues. Companies facing operational issue. There is no supply of the coal. Then companies facing financial issues. There is no support from the bank. Okay. Again, operational issue, that key management person are leaving. That's the problem. Again, no payments to the employees. They may also leave. So there are operational issues also. There are operational issues. There are financial issues. There are a lot of problems going on. A lot of problems are going on, and these guys are not having a perfect plan how to survive these particular situation. How to survive this particular situation, and because there's state of confusion, they have continued what they did last year. They have continued the accounting on the basis of going concern. They have continued the accounting on the basis of going concern. Now, guys, in this, different things are possible. See, we have been given a situation. You need to further probe in detail a lot of things. How much money they are having, how long they are going to survive. Further, in more detail, we need to probe. Different conclusions are possible. One conclusion is, yes, that there is a material uncertainty. Material uncertainty means big uncertainty. That's a broad meaning. Specific meaning, that means going concern depends on happening or non-happening of future events. Happening or non-happening of future events. The one conclusion is that there is a material uncertainty over going concern. Now, if within next 1 year they get the supply of the coal, everything will be fine. So there is a one conclusion, that there is a material uncertainty. Okay, material uncertainty is there, but still that uncertainty is within control. It is 20-30% chances that we may not get the supply. There is a material uncertainty involved. So going concern depends on happening or non-happening of future events. Okay, if you say that uncertainty is within control, we will say that going concern is still valid. And if you say that it is not within control, it is crossing 50%, we'll say that going concern is invalid. So one conclusion can be there is a material uncertainty, but going concern is valid. The next conclusion is no, going concern is invalid. They cannot survive. Okay. Once again, guys. So a case is given where a lot of operational issues are there, a lot of financial issues are there, and as an auditor, we are supposed to comment. So before we comment in this particular situation, okay, either you can say that there is a material uncertainty, but that uncertainty is within control and going concern is still appropriate, going concern is still valid. And you make audit report accordingly. And next thing is that you say that no, material uncertainty is not within control. There is a high probability, more than 50% probability they are not going to survive. And you say that the going concern is invalid. And then you do audit report accordingly. So which particular point of action we should go ahead with? Institute has taken the point of view that there is a material uncertainty involved. Yes, it depends happening on future events, but that uncertainty is within the control and going concern is still appropriate. They have taken that point of view, guys. They have taken that point of view and they have answered accordingly. So I will also say that in this particular situation, you also go with that point of view that material uncertainty is there, but it is within control. Going concern is still valid. Answer accordingly. And at the end, you say that one more point of view was possible, that going concern is invalid. And then as per that, audit report could have been prepared. Okay. So what course of action? So what kind of reporting? Again, guys, so what we are supposed to discuss, what kind of reporting we'll be doing. Okay, let's see. Just a minute, guys. They are saying that going concern is sorry. So they have taken the other view only. That going concern is invalid. Going concern is inappropriate. They have taken that point of view only. Okay. So let's again crystallize. They say that yes, material uncertainty exists. Heading is not appropriate, guys. When there is material uncertainty and going concern is inappropriate. Going concern is inappropriate. Okay. Now, as a standard answer, what should be done? I will tell you. Whenever they have this, whenever you get a case, whenever you get a case, okay, about going concern, that there's a problem with the company, operational issues, financial issues, and so on. Whenever you get such case, so first is give reference of 570, give the full name, give reference of 570, then you explain in short in one line, 2 and 3 steps. The first step in SA 570, you go and look for whether there are events and condition which create significant doubt over going concern. If there are, then we perform step number 2, we get additional information about those events and condition, whether it's financial issues or operational issues or legal issues. We try to get more information. Okay, and then in step number 3, we make conclusions. First, we make conclusion whether material uncertainty exists, and then we make conclusion about going concern. If we feel that yes, going concern depends on happening or non-happening of future events, some certain external events, there's an uncertainty involved, we call it MU, material uncertainty. And then we have to go for the going concern. Okay, going concern may be appropriate if material uncertainty is within control. Uncertainty is within the control. The chances of collapsing is less than 50%. Going concern can be valid. Or if it is not within control, going concern may go for invalid. Conclusion first about material uncertainty and then about going concern. When we talk about when it comes to going concern, conclusion can be it is appropriate, it is inappropriate, or it is doubtful. So you first explain that in SS 570 we are supposed to perform 3 steps. Then you focus on looking at the case, you focus on whether there is a material uncertainty and what about the going concern. Whether there is a material uncertainty, whether material uncertainty is involved, and what about going concern. Okay, so if you say that there is a material uncertainty involved, you must be aware that it should be disclosed in notes to accounts. What are the principal events and conditions, whatever financial, operational, other, explain that. You need to give warning to people that there is a material uncertainty, and because of that, assets may not be realized in normal course of business and all liabilities may not be paid in normal course of business. So that disclosure should be there in notes to accounts. Okay, and then accounting should be done as per whatever conclusion about the going concern is: valid, invalid, doubtful. And then we are supposed to report focus and its treatment, and then we are supposed to report. If management has done everything fine, we will go for the unmodified report. If they are not done things properly, we will go for the qualified or adverse report, as the case may be. So in this case also, you discuss as a 570, explain in short 3 things. Then in this particular case, institute has said, okay, there is a material uncertainty. Material uncertainty depends on happening or non-happening of future events. Okay, so here in this case, there is MU, material uncertainty, so it should be disclosed in notes to accounts. There is MU and it should be disclosed. It should be disclosed in notes to accounts. But as per the question, it should be disclosed in notes to account. First discuss that. And then going concern is inappropriate. There is no realistic plan to save the company. Going concern is inappropriate. So they should shift to liquidation basis accounting. Okay. Now with respect to reporting, no disclosure about MU. So if there is no disclosure about MU, we give qualified adverse. Going concern inappropriate. Still they are not doing proper accounting, we directly go for adverse. So end result is we are going to give adverse report. Let's freeze, guys. If you get the question on going concern, give reference of Psi 70, you talk about 3 steps, then depending on the case, you sit down and think about it. What is the situation, whether there is material uncertainty or not, and what is the situation of going concern. You think about that, and accordingly things will go ahead. In this case, there is a material uncertainty and going concern is inappropriate. They are not doing proper disclosure of material uncertainty, so they should go for qualify adverse. Qualify adverse as the case may be. And going concern is inappropriate. Still, they are not doing anything. So directly adverse. So end result is we are going to give adverse only, guys. We are going to go for adverse only. So, and one very important thing, before we go for the discuss case thoroughly, case discussion should happen. Discuss case discussion should happen thoroughly. Now guys, let's see. And they have, again in conclusion, they have included Caro also. Yes, in Caro 2020, there is a clause, okay? Nineteen number clause is there. 19 number clause. 19 number clause is there. Clause 19. And it asks auditor to report whether there is a material uncertainty on the company. So in Caro, we are going to report there is a material uncertainty. So end thing is we are going to say, let's go for the adverse report and then let's make a report under Caro also. Okay guys, so I have given a standard flow, but this is going to be the critical portion. This is going to be the critical portion, whether see, in general I am giving advice that generally there is a material uncertainty involved, generally. So it's a high probability, okay, MU is always there. And then when it comes to going concern, it can be going concern is valid. Next 1 year they will be able to continue. Going concern is valid or going concern is invalid. These two things can come up depending on the situation. And if you have a doubt, write one assumption, write one thing, and then you write at the end the other assumption also. Yes, this is going, these cases are going to be a little tricky, guys. Now, November 23 mock. November 23 mock is a very interesting, guys. Evaluating cash flow forecast. Just a minute, give me a minute, guys. Okay guys, come on, let's see. Evaluating cash flow forecast. Now, so this is again a company involved in, again they have made a case out of it, engaged in manufacturing and export of ready-made garments. Ready-made garments, the company has lost overseas buyers to Asian competitors. So they are into ready-made garments, but then there's a problem. They have lost the customers. They have lost the overseas buyers to Asian competitors. There's a problem. There's problem on the sales side. Lost chunk of export orders. So export orders are not there. More pronounced and it is further increasing. Further, US economic recession. US economic recession caused delays in companies' overseas payments. So there is a problem. There's a problem that they are not getting good orders. Good orders, that's the problem. They are not getting their money. That's the next problem. They are not able to repay loans. Repay loans, that's a problem. Not able to pay creditors on time, that's the problem. There is an extra cost of interest cost, declining revenue, and there are fixed costs already there. Already employee layoffs has started. All this doubts the company's ability to continue as going concern while conducting statutory audit. He is studying management's assessment of company's ability to continue as going concern by studying projected profitability statement for the next 2 years. Next 2 years containing turnover, expenses, profit estimates. Comment on the above situation with specific reference to audit procedures. He is studying projected profitability statement for the next 2 years containing turnover, expense, profit estimates. Comment on the above situation with specific reference to audit procedure being performed by CAP in context of standards on auditing. So, okay. Again, the setup is on the same lines. Setup is on the same lines, but then in the earlier question, they clearly said they don't know how to come out of it. So they have given up. So that was a big indicator that going concern is invalid. Going concern was invalid. Now here there are simply problems are there. Okay. There are operational problems. There's a problem with the sale. There's a problem with the finance, recovery and payments, and things are going bad. And here things are going bad out here. And now as an auditor, we are studying certain things. Let's see what's the approach. Now, they're giving reference of 570. The most important thing is should focus on cash flow forecast and not future profit projection. Okay guys, let's understand. And what they should exactly do. Now, let's understand. Guys, let's understand the core and then we'll come to the answer writing. SA 570 talks about 3 steps. Step number 1, you look for events and conditions which create significant doubt or going concern. If there are events and condition, you go to step number 2. That is get additional information. Get more information, additional information. And step number 3 is you make conclusion about material uncertainty and going concern, and then you make audit report. 3 steps. Okay. Now, when we say that where we perform additional procedure, okay, an institute has given SA has given the list what you are supposed to perform in additional procedure. So they say that if management has not yet prepared the going concern assessment, ask them to prepare going concern assessment and take that. So first take management's assessment about going concern. Ask management that you prepare your assessment about the going concern and give that assessment to us. Simply give that assessment to us. Okay, we'll study that, analyze that. We will see and we'll understand the issues better. Financial issues, operational issues, legal issues. Then give your management plans, how you are going to protect yourself from these problems. And after getting these plans, depending on this plan, prepare a cash flow forecast of next year, that how much cash you are going to generate in next year, maybe monthly basis, and how much payments you need to make. where there is a shortage, where there is a surplus, if there is a shortage, from where you are going to pay for the shortage. Okay, that analysis should be there. So in that, the very important thing is cash flow forecast analysis, cash flow forecast analysis. And here these guys, they, here a chart accountant is focusing on profitability statement. So that is where the person is going wrong. He was supposed to focus on cash flow forecast and not the profit forecast. Very deep they have played with this. Okay, very deep they have played with this. It is in November 23 mock, very high probability that something like this comes up. Something like this comes up. So if there are cash flow forecasts, you're supposed to get cash flow forecast, and when you get the forecast, study it, analyze it, where there is shortage, what there is surplus, what if there is a shortage, from where you will get the money, and so on. And most importantly, whenever you make a forecast, you need underlying data of the previous year or average data of the previous past years, whether that data is complete, accurate and reliable, relevant data is there. And then you need assumption, what will happen in the future. Revenue will grow, expenses will grow, at what rate they will grow. So you need assumption, you need to check these two things a lot. Okay, let's freeze, guys. So how this answer should be there? First, SA 570 reference full name, tell it is about going concern. Always explain the 3 steps, that we should look for events and condition getting significant doubt, then we should go for additional procedures about the issues, try to understand whether there is a material uncertainty and so on, get more information. And step number 3, make conclusion about material uncertainty, make conclusion about the going concern, and then report accordingly. So explain that. Here you discuss about additional procedures. You can discuss, generally there are 5 points. There are generally 5 points in additional procedure. If you remember, that's fine. So you explain those 5 points. First one is management assessment you have to take and read that and understand the issues. Then you need to ask for management plans to save themselves, whether the plan is adequate, it is going adequate and feasible. Then you ask for, on the base of plan, cash flow forecast. You look for the data is appropriate, assumptions are good. Then you need info after you need additional info. What is that? After date of preparation. We always ask when these analyses were made. Suppose these analyses were made 5 months back. So what has happened in the 5 months? Favorable, unfavorable things. And last, we need WR, written representation, that tell that yes, your plans are adequate, they are feasible, you are going to protect the company is going to survive. We want a written representation from the management. Then you discuss the case here, that the auditor is focusing on the profitability statements, and that approach is not appropriate. He is supposed to focus on the cash flow forecast, and he is supposed to check the data and assumptions. So conclusion, his approach is not appropriate. He should focus on the cash flow forecast and analyze it thoroughly. Beautiful case, lovely case, new case. Such case was not there earlier. Okay guys, let's freeze, guys, once again. Okay, so the earlier one, but then as I have discussed, again I would like to discuss that and freeze in your mind. If they come across a negative story about any company, anything like that, give reference, go for 3 steps. Okay, then try to understand whether there is a material uncertainty, generally there is a material uncertainty always present, generally I'm saying. And then you try to focus about going concern, whether it is valid or invalid. Only these things are possible. Okay. Now, if going concern is invalid and they are not doing anything, we have to go for adverse reporting. If going concern is invalid, we have to go for adverse reporting, and then you answer accordingly. If going concern is valid, that's great. If going concern is valid, so we have to report only about material uncertainty and accordingly. So depending on the situation, you will always get an answer whether going concern is appropriate or not, and accordingly reporting will take place. Okay. And you can always give reference wherever there is a material uncertainty. You can always give reference of CARO clause number 19. Say clause number 19, auditor is supposed to comment whether material uncertainty exists in the company. Whether material uncertainty exists in the company. Okay. Now, so that was an interesting case, guys. Now, study material 23 question is there. CS Samir is a statutory auditor of Tram Limited for financial 2023 while conducting the audit to issue unmodified report. Okay, so auditor is thinking to give an unmodified report, clean report that financial statement give true and fair view. But there is a material uncertainty. So they are simply saying there is a material uncertainty. In respect of companies able to continue as going concern for the pending litigation of labor laws. In view of that, the company has made appropriate disclosure with respect. They have made appropriate disclosures. Appropriate disclosure with respect to pending litigation in notes to accounts. Explain how will Samir deal with the above situation. Okay. So let's freeze, guys. As I said again, you have to follow the same thing. Now here you need to always follow the same thing. Give reference of SA 570. You explain the 3 steps. And now in this situation, there is a material uncertainty, and management has done proper disclosure. But there is a proper disclosure notes to accounts, and going concern is valid. If material uncertainty is within control, going concern is valid. If it is not within control, going concern is invalid. Both the things are possible, guys. Both the things are possible. So here we don't have to make any judgment. They have straight away said that there is a material uncertainty and going concern is valid. So what will happen in this case? It's very simple, guys. And they have further said that material uncertainty is properly disclosed in notes to accounts. So let's freeze. Situation is there is a material uncertainty, but going concern is valid. It's very simple. As an auditor, we need to see whether they have disclosed properly. If they have disclosed properly, we are supposed to put a separate section, MUGC section, material uncertainty over going concern. So always keep this in mind. If management is disclosing material uncertainty properly, we are happy with them. We will put a separate section of MUGC, material uncertainty over going concern. And we will also alert everyone. We'd like to inform everyone that so and so are the issues and challenges. And because of that, there's a material uncertainty. You can go and read the details in so and so notes to accounts. There is a material uncertainty. We'd like to tell that we are simply telling about the material uncertainty. Okay. And because of proper disclosure, financial statements give true and fair view. We are not modifying our opinion. We will highlight material uncertainty and at the end we'll write that we are not modifying our opinion. We are supposed to draft that paragraph here. We are supposed to draft the relevant portion of the audit report. So just before the basis of opinion section, material uncertainty related to going concern, this particular section will come up. And we'll write there, we draw attention to note number so and so, indicate that there are litigations outstanding against the company, and because of that there is a material uncertainty on the company. material uncertainty of the company, creating significant doubt about ability to continue as going concern. You can read in note number 10 all the details. But we'd like to say that we are not modifying the opinion. We are not saying that financial statements, we are not saying that there is a problem with any true and fair view. So this particular paragraph needs to be drafted. So we explain the issue and the matter. We explain from so and so note. You don't need to cram. Explain the issue, whatever is the matter. There's a problem of labor law case, pending litigation case of labor law. Explain the matter. You can get details from notes. Okay. And yes, there is a material uncertainty out there, material uncertainty, and because of which there is significant doubt or going concern. Yes, it is there. But as on today, we are not modifying our opinion. We are happy with the accounting they have done. Guys, I understand these cases about 570 are little tricky. I really understand these cases about 570 are little tricky. But then as you sit down and you practice it, you will become comfortable better and you will be giving better answers. Even if you match 70 to 80% of what about their expectation, you should get good marks out of it. Again, this question was there in study material, then May 23 mock paper. There are two questions out here. Again, they are showing that there's a problems. So the situation is management agreed that there is an uncertainty about going concern, and it will be disclosed. It will be properly disclosed in notes to accounts. Okay. So situation is, yes, there is a material uncertainty. So situation is, yes, there is a material uncertainty. Okay. And management, so in step number 3 of the standard, there is a material uncertainty. So the conclusion is clear and they are ready to disclose everything in notes to accounts. That's really great. They are not talking about what exactly will happen with respect to going concern. Okay. So I will say that when they give up that there are no plans at all, when they give up that there are no plans at all, you say that the going concern is inappropriate. But here they have not given up. They have not given up. So we'll assume that going concern is appropriate. So situation is pretty clear and simple, that material uncertainty is there, but going concern is appropriate. What will you do as an auditor? It's pretty simple, guys. We'll first ask, are they doing adequate disclosure? If they're doing adequate disclosure, that's great. We will also disclose in our audit report a separate section, MUGC, material uncertainty over going concern, a separate section. We'll explain the matter, we'll give the reference, we'll give the reference, and we'll tell people there's a material uncertainty and say that, but our opinion is not modified. So our response will be to put a MUGC section in our audit report. That will be our response. So the situation is material uncertainty exists. So we'll ask management to disclose all the events and conditions, whatever they were, financial events and conditions or operational or legal. And they also need to warn people, because of that they may not be able to realize assets in normal course of business and pay liabilities. If they do this proper disclosure, which they have said they will do the proper disclosure, we will give an unmodified opinion and a separate section, material regarding going concern will be there, and those details will be, we have just discussed those details. So let's freeze, guys. As I said, generally material uncertainty exists. And next, when we talk about going concern, if they are giving up, say going concern is invalid. If they are not giving up, say that the going concern is valid. MU plus going concern is valid. Now you would have realized that with MU there can be two situations: going concern valid, going concern invalid. Now, so it is there in May 22 and May 23 mock. So earthquake has taken place, which has destroyed a lot of business activity. There is a material uncertainty. They are not disclosing it in notes to accounts. They are not disclosing material uncertainty. What kind of opinion should the auditor give in these circumstances? Also draft the opinion and basis of opinion. Okay, let's freeze, guys. We'll give reference of 570. We'll explain that 3 steps need to be performed. And then we explain that if the material uncertainty is there, it should be properly disclosed in notes to account principal events. Then next, it is a material uncertainty. You warn people, assets may not be realized in normal course of business, liabilities may not be paid. You do that. Okay. So that is what management is supposed to do. And if in this case and then you have to make conclusion about the going concern. Here going concern looks up going concern here the complete question is about material uncertainty. Going concern looks appropriate, absolutely fine. Now you discuss the case. The case is that they are not disclosing material uncertainty. If they are not disclosing material uncertainty, it is a crime. If they are not disclosing material uncertainty, it is a crime. We'll have to give qualification, or if required, we have to go for adverse opinion. We have two options available. Okay. We may go for qualification, we may go for adverse. If material uncertainty is not disclosed, we may go for qualification, we may go for adverse, depending on situation. See, in some companies, going concern is going to have very huge impact. Huge losses will pile up. In some companies, it may not have huge impact. For example, majority of the assets were already at the market value. This company is into share trading and they were already on the market value. So there is no big impact of going concern. So we may go for qualification. Here they have taken the most unfavorable point of view, and they have gone for adverse opinion. So first explain SA 570, explain 3 steps, explain the requirement. If there is a material uncertainty, there a disclosure is required with respect to that. If it is not given, we may go for qualified adverse and discuss the case. This, yes, they are not ready to disclose. They are not ready to disclose things. So we will have to go for the adverse. So draft a adverse opinion, which is very simple. In our opinion, to the best of the information explanation given to us, because of the significance of the matter explained in the base of adverse opinion, we say that the financial statements of so and so company for so and so year doesn't give true and fair view. Doesn't give true and fair view. Then we go to the basis for adverse opinion. We explain that company is facing earthquake, there are a lot of issues, there are operational issues, financial issues, there is a material uncertainty. It was responsibility to disclose material uncertainty in notes to accounts. They have not done that. And because of that, do not disclose this fact. They are not disclosing the fact. Okay, that's the issue, that's the problem that's the problem in financial statements. And because of that, we are giving adverse opinion. So you give adverse opinion and you give the reasoning and the logic in the basis for adverse opinion. Give reasoning and logic in basis for adverse opinion. Okay. Now, again, guys, they are focusing again and again, material uncertainty not disclosed. This question was asked in May 22 and May 23 RTP. So they are giving they are giving aging of trade payables. Aging of trade payables. So lot of amount is pending. They have not paid 2 crores less than 1 year, 4 crores, 1 to 2 years. So basically, they are saying that they are financial trouble. By showing the accounts payable aging, they simply want to say that there is problem with the trade payable. There's a problem with the trade payable. There's a financial issues going on. So all the ratios have slipped drastically. Again, there are problems. So basically, there are negative issues, there is a material uncertainty, and nothing is disclosed in notes to accounts. Again, it's a repetition, guys. Again, it's a pure repetition. It's again pure repetition. Material uncertainty not disclosed. So we'll have to give qualify or adverse. Explain everything. Depending on situation, we'll have to modify the opinion. We'll either have to give qualified or adverse opinion in this situation. Okay, guys, before I end up 570, again I would like to give you a standardized way of dealing with things. So we are through with 560 subsequent events, lovely cases we have seen. 570 is always like this, there will be some cases by institute where there is a lack of clarity. Okay. Now, once again, if you get a case on 570, give the reference, explain the 3 steps we do. We look for events and condition creating significant doubt. After that, we perform additional procedures, try to understand, get more and more information, so that get more and more information. In step number 3, we first make conclusion about material uncertainty and ask management to disclose accordingly. If there is a MU, disclose that. If there is no MU, absolutely fine. Okay. So we ask for the MU disclosure, and then we go for the going concern. Going concern can be appropriate, can be inappropriate. This is famous in the cases. Okay. The doubtful thing is not that famous. If they give up, going concern is inappropriate. If they don't give up, going concern is appropriate. Okay. This is the thought process you can go with. Now, depending on the situation, if they are disclosing about the MU, we are going to put a MUGC paragraph, material uncertainty of going concern. If they are not going to disclose MU, we are going to qualify or give adverse. We are going to give qualify or adverse. Okay. Next, if going concern is inappropriate and they are not listening to us, simply we are going to give adverse only. If you remember and write down the standard flow, and if you understand the standard flow, you will be able to solve any case of SA 570. Any case of SA 570, guys. Okay. Now, let's go through 580. Let's go to 580. There are a lot of interesting cases they are discussing about 580. And then we will be through with this particular chapter, guys. We'll see few more questions of the next chapter also. Let's see. Now, they are pretty simple cases. The first thing is the very famous question, very famous. So, auditor is going and simply, auditor is, just a minute, guys. Okay, guys. Now, 580, it's a very traditional case asked many times again and again. A very traditional case asked many times again and again. Let's understand. So, what is this case all about? A pretty simple, straightforward. What they're doing, they're misusing written representation. They're misusing written representation for fixed assets. They're taking written representation, and so auditor is not performing audit procedures properly, is not collecting audit evidence. He's simply taking written representation about the fixed asset, plant and machinery. He's simply taking written representation about the inventory, and then he is giving his opinion. That's absolute misuse of written representation. So what you are going to explain? Number one, written representation cannot substitute any audit. It cannot substitute any audit procedure or any audit evidence. Okay, it cannot substitute. You cannot reduce any audit procedure or any audit evidence. Written representation is taken at the last. It is not a primary evidence, it is a supporting evidence. So you need some evidence and it can support it. So you explain it cannot substitute anything, then you explain it is not a primary evidence, it is a supporting evidence. You need some primary evidence and it can support it. And then you say that, so approach of the auditor is absolutely wrong. It is not as per SA 580. That's a complete non-compliance of SA 580. There's a misuse of SA 580. That's the conclusion. You give reference of 580, explain these points, discuss the case, and then you say that the approach is not proper. So first they're explaining the concept, then discussing the case, and then they're saying that what auditor is doing is not appropriate. What auditor is doing is not appropriate. So those points are only explained, guys. Explain those points, it is absolutely fine. Now this question is dying to come in exams. Study material 23, November 19 RTP, May 21 mock. You are supposed to explain about date of the audit report and the period which should be covered. Date of the audit report and period which should be covered. So it's very simple, guys. Let's understand. We'll first explain audit. First explain written representation is a audit evidence. We understand it is a supporting or written representation is a supporting audit evidence. Because it is an audit evidence, it should be always taken before signing audit report. So it should be always taken before signing audit report. You explain that. It should be as near as possible to signing so that we get the latest written representation, and it should cover all the subsequent events, all the subsequent events. So we should keep it as close as possible to the balance sheet date. First explain this concept that before audit report and as near as possible. Why as near as possible? Okay, so that is the most important thing. Then this can definitely happen that we took certain representations during the year, and we may ask for the updated written representation. Okay, but again keep this in mind, this updation should be done before signing audit report. Then which periods? We should take written representation for all the years for which we are giving opinion. If we are giving opinion on 2 years, we should take written representation for 2 years. We should take written representation for 2 years. We discussed this in SS 710 that in some cases we give opinion on current year as well as previous year. This happens in case of prospectus, that we give opinion on multiple years. So it's very simple. We should take written representation for all the years on which we are giving opinion. If it's 2 years, we take it for 2 years. If it's 3 years, we take it for 3 years. If it's for 1 year, we take it for 1 year. So it's very simple. Okay. Now, sometimes management may say that, listen, last year you took written representation for last year. Are you going to need again? Yes. If we are giving opinion, we will need written representation again, because that written representation was as on that last year, and this written representation is as on current year. So number of times we give opinion, that number of times we take written representation. Next, management will come and say, management has changed. Last year CEO, CFO was someone else, and this year CEO, CFO. Doesn't matter. It's your headache. You go and understand whole last year, understand every damn thing, and you give me written representation. Okay. So it doesn't matter if there's a change in management, it is still your responsibility. So explain, it should be before date of audit report as near as possible. You explain all the periods should be covered. These are two major things. There are two major things, and in that, you explain that if there's a change in matter, change in management, it doesn't bother. You have to give written representation to us. We have given the summary also at the end. Now this question is interesting. This question is interesting, guys. Let's understand. Very interesting question, and very high chances it will come in exam. What they say, that audit was completed on 31st of July and written representation was taken on 15th of April. So 15th of April, 15 days of April, then May, June, July. Written representation is taken 3.5 months before signing. There's a gap of 3.5 months before signing. So they have given this written representation. They have drafted it, and a lot of things are written, but that's not the real case. The real case is this gap. The real case is this gap of 3.5 months. Gap of 3.5 months. That's the real thing. All this thing is useless. It's of no, don't read all those things. Now, so what should be done? Guys, explain everything which we have discussed in the previous question. You explain that it should be before signing, it should be as close as possible. Okay. If there are updations, it should be before, all the periods should be covered. It doesn't matter. Even if we have written last year, we'll again take it. Even if there's change in management, again we need it. We explain those 2 points about date and about the period, and then you discuss this case. There's a gap of 3.5 months. Okay. There's a gap of 3.5 months. So this is the concept. In very short, they've explained the concept. I will tell you that, discuss the concept in depth. And then here, there is a case discussion. And then they have given the conclusion that so much gap is so much of gap is not appropriate. That's what the conclusion is. So much of gap is not acceptable. It is not appropriate. It's a problem. It's an issue at the part of the auditor. Auditor is not going fine. It is a problem with the auditor. So that's the mistake from the auditor's side. So guys, we have covered 3 essays: essay 560, essay 570, essay 580. Okay. Now let's quickly go to the next chapter. Guys, I understand some cases were really tricky. 570 had its own flavor, but that's fine, guys. Okay. Now, let's come to essay 700. So the first question is about the first question is about drafting. Let's understand. We are talking about essay 700, but then drafting cases are also covered here. Uh, the first is SS700, but okay, let's understand this, guys. So it is from May 22 RTP. So what they're explaining out here is that management has introduced first. The first problem is person is appointed after year end. Person is appointed after year end, so person was not able to attend physical verification as on balance sheet date, physical verification of inventory as on balance sheet date. He was not able to see the status of inventory or cash or fixed asset as on balance sheet date. Exactly, that's the first problem. Next problem is they have introduced new system for accounts receivable, and that system has triggered a lot of errors, and those errors are not rectified. There is a lot of issue with receivables. That receivables related information is not at all the receivable related information is not at all reliable. This problem rectification is still going on, and they're saying that the effect is both. Because of this, they are saying clearly unable to obtain sufficient appropriate audit evidence. They have clarified unable to obtain sufficient appropriate evidence. The effect is material and pervasive. Let's freeze, guys. So they've explained the situation that because of late appointment, not able to see closing balance of inventory and cash and other items, and because of this software, not able to get information about account receivable and related things. And this issue, so lack of evidence is there, and this is material and pervasive. Where there is a lack of evidence, material and pervasive, you go for disclaimer. So a disclaimer opinion. First thing, always keep in mind the first line. Don't write we have audited. Right? We were engaged to perform audit for so and so company, so and so financial year, covering so and so financial statement, notes to accounts, and because of significance of the matters which are explained in the basis paragraph, we were not able to obtain sufficient appropriate audit evidence, and we are not giving opinion on financial statement. Always say that reasons are given in basis paragraph, and because of that we are not giving opinion on financial statement. No need to cram, just focus on important things. While giving opinion, you need to give reference to basis paragraph, keep that in mind, and write that because of that not able to get the evidence, and that's why not expressing the opinion. That's a disclaimer. In basis of disclaimer, you explain about the late appointment. And because of the late appointment, not able to check inventory. Then you discuss the problem. Then you discuss problem with the accounts receivable, and there's lack of information, not able to understand whether inventory is appropriate, whether account receivable is appropriate, what is the whether they are appropriate, not able to understand whether adjustments are required, increase, decrease. Okay, explain the reason that these are the areas we are not able to get information. It is having pervasive and material effect. Okay, guys. So first case, this is not exactly as for SS700. It's a case of 705. By mistake, it has been allocated. To this particular SS700. Doesn't matter, guys. It's a question ultimately. Then study material 23 question is there. The auditor of listed company have affirmed their audit report communication of significant auditor finding. Affirmed in their audit report communication of significant audit finding, significant deficiency in internal control to TCWG, where such matter included in the audit report. So they are discussing that audit report is talking about communication of significant finding. In which particular part of audit report you talk about communication? Where? Okay, and importance of this communication. Let's freeze, guys. It's very simple. So one of the section of the audit. Okay. One of the section of the audit report is auditor responsibility section. In auditor responsibility section, there are three parts. Auditor educates people what is my overall objective and related things. Then he explained what is the scope of the audit. He explains the range of activities he performed during the audit. And then he explains people that I have kept everyone informed. I have communicated all the important things with the management and TCWG, so that tomorrow they cannot come and say that we were not aware what auditor was doing. We kept under the loop. So yes, this particular thing which they're discussing in the question, this is discussed in management responsibility section. And we have to discuss, we have to explain that. So simply give reference of as a 700, then you explain that there's an audit responsibility section, and in that we discuss about the communication. Broadly, we discuss three things: Kia, okay, we discuss Kia Motors. K stand for key audit matter. So in this part, we clearly discuss about key audit matter. We explain those charged with governance, that matters on which significant most as per auditor's judgment, matters on which significant most matters which were most significant as per auditor's judgment, matters which were most significant during the course of audit, they are key audit matter. So we identify the key audit matter, and we have discussed it with TCWG at the preliminary stage also, and audit report finalization also. Okay. So we explain in the audit report that there are key audit matters. These are key audit matters, and we discuss them at preliminary stage also and finalization stage also. They are generally discussed with the TCWG, and these matters are sometimes not disclosed if it is prohibited by law, or if they are not in, if we feel that the adverse effect is more than public interest. So you explain that yes, we have made all the point is we have K for key audit matter. We have made all the communication about key audit matter with TCWG. Then I for independence. Then you explain that we guys are we and our team was ethical and independent. We have given a statement to TCWG that we are ethical and independent. We have explained all the relationships, whether personal, financial, business, whatever our team is having, which create threats to independence. And we have also communicated the safeguards, how those things are compensated and how they are under control. So we make communication for key audit matter. We make communication for ethics and independence. Then we also make communication about audit. We discuss overall plan. What is the overall plan of doing the audit? Overview. What are significant findings and significant deficiencies? So you explain that yes, these things are discussed. These things are discussed in auditor responsibility section. There is a part for communication where we discuss the three things. We discuss about key audit matter. We discuss about ethics and independence. We discuss about audit plan and findings. Conclusion is very simple. We have to explain these things in the auditor responsibility section. Okay. So if you have knowledge that okay, in auditor responsibility section there is a communication part, you explain that communication part. That was the requirement of the question. Now very interesting, asked in November 19 RTP, study material 21 and then study material 23. Okay. So if you see, a similar question is there, but just it is made little case study based. It is made little case study based, nothing else. Same question, case study based. So what's the case study all about? It's pretty simple again, guys. So there's a company for which we are doing audit, and one investor is from US, and another investor is, it's basically a joint venture. One venture is from US and one is from Japan, and they are asking that when you draft your audit report, it should refer both companies in India. It should be as per standards on auditing. It should be ICai plus it should be as per international standards on auditing. So basically question is that when we frame our audit report, we should refer to both the standards. Is that possible? Yes. So you say that It's absolutely fine. SA 700 says that when we make our audit report, and in that we explain people which standards on auditing we are following, we can say that both, yes, we have done our audit as per standards on auditing issued by ICAI, approved under Companies Act, and we have also followed international standards on auditing. We can give reference of both. But then there are two conditions. Okay. First, there should not be any conflict. With respect to, there should not be any conflict as per both the standards. Both the standards, opinion as per both the standards should be same, and EMP OMP requirement as per both the standards should be same. You explain in positive manner or negative manner, doesn't matter. You simply explain that as per both the standards, the opinion should be same. So both the standards should say it's a clean opinion or qualified or adverse. Disclaimer, opinion should be same, EMP OMP requirement should be same. That's the first condition. There should not be any conflict. Opinions should not be different. EMP OMP requirement should not be different. There should not be any conflict. And then you explain it should have all the minimum element of the audit report. Cut that point. It is written by the institute. It is confusing. Cut that. It was given by the institute. We copy pasted it. 99.99% everything is as per the institute. We don't frame the answers. We don't want to get into controversy. But wherever we feel that things are grossly wrong or something is not there, we comment always that so and so changes should be there and so on. Then you explain minimum element should be there. From title to signature, the minimum elements, all minimum elements are there. If these two things are there, we can definitely give reference of standards on auditing. Okay. If any times when the auditor's report refer to both ISO auditing standard of specific jurisdiction and the standards on auditing issued by ICAI, the auditor's report should clearly identify the same jurisdiction of the origin. See, they are saying that yes, you can always refer to two standards. If instead of international standards, standards of auditing, say of Japan are used, you should always explain the origin of those standards. There, yes, standards of auditing of Japan are used. The origin, who made those standards, who approved it, it should be clearly specified. The origin, who are the creators and preparers of the particular standard. If we are using standards of any other jurisdiction, so let's freeze, guys. Referring to two standard is absolutely fine. Two conditions should be fulfilled, and if any time you refer to a standard of a particular region, you should always explain the origin. Then November 23 RTP. November 23 RTP, they are discussing the concept of supplementary information. They are discussing the concept of supplementary information, guys. Let's first understand the supplementary information. What is supplementary information, and then what point of view they are taking. Okay. So let me show you this this small chart is there. A simple chart is there. What is supplementary information? If financial statement is having any additional information which is not required as per applicable financial reporting framework, which was not required as per applicable financial reporting framework, it's called supplementary information. This information can be given voluntarily, like list of debtors and list of creditors, or maybe it can be given as per requirement of some law. MSME Act or some other act or laws, different laws are there prevailing, it may say that give this information. As an auditor, we are supposed to evaluate, very important, we are supposed to evaluate whether it is absolutely necessary to keep this information here. Is it an integral part of the financial statements? It cannot be placed anywhere else, and this is increasing the interpretational value of the financial statements, whether it is having a very close connection with the financial statement. So we used to see, is it very useful and it's very necessary to keep it here? If answer is yes, for example, a profit reconciliation is given. Profit reconciliation, that this is profit as per Ind AS, and plus minus few things, and the reference is given from where this is coming, plus minus few things, and then you get profit as per US GAAP. So because financial, exactly some of the financial item details are involved, it is very useful thing for the US investors. It is very useful things for US investors, and it should be there because you are taking figures from the financial statements only. If it's an integral part, or how much amount is due to MSMED, micro small medium enterprises. Micro small medium enterprises, now it is required as per Schedule 3 only. Again, a lot of information is coming from notes to accounts only. If it's yes, then it is considered as a part of notes to account. It is considered as a part of notes to account. Check it like you check any other notes to accounts and report accordingly. But if it's not an integral part, it's an extra information, it is not required. Ask management to differentiate it. Come on, differentiate it. Come on. It should be differentiated. It should be placed. First, financial statement will be completed. After that, there will be a separate area, unaudited supplementary information. In that, you put all the information. Don't give cross-referencing. Okay, financial statement should not have reference of those notes. Those notes should not have reference of financial statements. There should not be any cross-referencing. Okay. So remove it, differentiate it. If they don't do it, if not, we'll give it in the audit report that note number so and so, so and so, so and so are not required by financial reporting framework. They are supplementary information. We have not done our audit keeping those things in mind. So as per our understanding, it's an unaudited information. It is an unaudited information. It is simply other information for us. In 720, we discuss other information. So it's like it's other information for us. So that is information. It's other information. All the information in annual report other than financial statement is other information. So you simply explain what is supplementary information, give examples. Our responsibility is to evaluate, is it integral part? Is it really useful and necessary? If yes, if answer is yes, okay, if it is useful and necessary, then we treat it as an integral part. Yes, we cover it as notes to account. If no, we ask management to differentiate. If they don't listen to us, okay, we specify in audit report that it's unaudited for us. So here in this case, they are giving information, average revenue per booking. They are giving number of bookings they have done in current year and previous year. That previous year there is 36,500 booking. This year they did 39,000. What is the average revenue per booking? 3,500, 4,200. What is the booking ratio? Organic to inorganic, 1:2, 1:1.65. Now, no Ind AS, no AS, no Schedule 3. Framework doesn't say to give all this information. This is purely a supplementary information. Give reference of SS 700, explain all the points which we just discussed. We explain all the points. Explain all the points we just discussed. Okay. And then you explain is that if management is not ready to differentiate it, to put it separately as unaudited supplementary information in our audit report, we'll explain that these notes are not as per applicable framework, the supplementary information, they were not required here. We have not done our audit keeping this in mind. So these are unaudited information for us. In fact, we are treating it as a part of annual report. It is other information for us. So explain that thing. So explain whatever we discuss in the chart, discuss the case, and say that if you don't do it, we'll put in the audit report. If management refuses, we'll put in the audit report, guys. Let's, how many cases are there in 701? One. Okay, a lot of cases are there. 6 questions are there. We will not be able to finish off the 6 questions. Let's take 1 or 2 questions more. Let's see, guys. Illustrate the presentation audit report if the auditor has determined there is no key audit matter to communicate. No key audit matter to communicate. Let's freeze. So if you study SA 701, it says that there can be a situation where key audit matter is applicable. Like it is applicable to listed company. It is applicable to listed company. If you're doing audit of a listed company and those financial statements are general purpose financial statements, general purpose financial statement, complete set of financial statements. So key audit matter is applicable. If key audit matter is applicable, and it can happen that during the course of audit things are so simple and straightforward. It's for a simple trading company. There is no key audit matter to report. There is no key audit matter to report. Or there was a key audit matter, but it is not reported because prohibited by law or because it is not in public interest. It is the adverse effect. Adverse effect will be more than the benefit public interest. So what to do in this case? So SA 701 says that once key audit matter becomes applicable, you have to incorporate a section, give a heading key audit matter, and explain there is no key audit matter to report in current year, or explain there was a key audit matter, but we are not reporting it because it is prohibited by law, or explain there was a key audit matter, but we think that adverse effect will be more than the public interest. Okay, so they are explaining a particular they're explaining one particular situation there. One more thing I would like to add, then only you will be able to understand. If there is a matter of modification, suppose there is a matter of modification, it can be qualification, or adverse or adverse. There's a matter of modification, and we have worked really hard on that matter. So matters on which you work really hard during the course of audit, the most significant matters of the audit, they are called key audit matter. So point is, this matter is a matter of modification and it's also key audit matter. So where are we going to explain this matter? Whether in the basis of modification paragraph or key audit matter. In basis of modification paragraph. Modification is a very big thing. There is a dedicated section for it. Basis of modification, it will be always matter of qualification, always matter of adverse, always disclaimer, whatever it is there, it will be always explained in basis of modification only. Now you have worked really hard on it. So it was a key audit matter also. So in key audit matter, you will just write one sentence. That matter which was explained in the basis, we worked really hard on it and it was a key audit matter. For details, you can read that section. So here they are giving example. Guys, here they are giving example. Let's see what they're in. Except for the matter described in basis of qualified or adverse opinion or material uncertainty related to going concern section, we determine that no other key audit matter to communicate in our report. Okay. On same line, if there's a going concern issue, material uncertainty, it will go to material uncertainty over going concern. There's a separate section, it will go there. If we have worked really hard on it, it's a key audit matter also. So we'll simply write one line reference. So let's freeze, guys. In key audit matter, in key audit matter, if key audit matter is applicable, give heading key audit matter. Okay. Write that, write there clearly. If there is any item of qualification or adverse, you have really worked hard, that right, yes, there's a matter in the basis of qualification or base of adverse, we have really worked hard on it, it's a key audit matter. No need to rectify, cram the word exactly. Yes, these were key audit matter explained in this paragraph. Yes, material uncertainty of going concern was a key audit matter explained in so and so paragraph. Except that, there is no other key audit matter. Sir, why no disclaimer? Because if you study SS 701, you understand that if there is a disclaimer, we cannot put key audit matter because they are contradictory in nature. Disclaimer means we were not able to do audit, and key audit matter means we have worked really hard on particular item. Because they are contradictory, both things cannot come together. If there is a disclaimer, then we delete key audit matter section, it never comes there. So I hope, guys, you understood this particular case. Let's stop here, guys. We'll continue tomorrow. So we have done one question of 701 also. Bye bye, everyone. Do put your lovely comments. We really love your comments.